Something unprecedented is unfolding in global silver markets, and the price discrepancies emerging across different trading venues reveal a crisis that most investors remain completely unaware of. While COMEX futures contracts in New York show silver trading around $73 per ounce, physical silver dealers in Dubai are quoting prices between $127 and $140 per ounce for immediate delivery. This isn't a temporary glitch or a brief arbitrage opportunity. This represents a fundamental breakdown in the pricing mechanism that has governed precious metals markets for decades. The catalyst for this extraordinary divergence traces directly to policy decisions made in Beijing during the final weeks of 2024. Chinese authorities implemented sweeping restrictions on silver exports, effectively cutting off the flow of physical metal from the world's largest silver-producing nation to international markets. This wasn't a gradual policy shift announced with months of warning. Chinese regulators moved decisively and quickly, leaving Western markets scrambling to secure physical supply from alternative sources that simply don't exist at the scale required to replace Chinese production. China produces approximately 3,600 metric tons of silver annually, representing roughly 13% of global mine supply. However, China's role in the silver market extends far beyond primary mining production. Chinese refineries process vast quantities of recycled silver, and Chinese manufacturers consume enormous amounts of silver in electronics, solar panels, and industrial applications. When China restricts exports while simultaneously maintaining or increasing domestic industrial demand, the mathematics of global supply and demand shift dramatically and immediately. The Shanghai Futures Exchange compounded the supply shock by reducing position limits for silver contracts by 50%, from 6,000 lots down to 3,000 lots. This technical adjustment might seem mundane to casual observers, but experienced commodities traders recognize this move as a clear signal that Chinese regulators are preparing for significant price volatility and want to limit speculative leverage in their domestic markets. When exchanges reduce position limits, they're effectively telling the market that they expect price movements large enough to threaten the solvency of highly leveraged participants. Meanwhile, COMEX silver contracts continue trading at prices that seem completely disconnected from physical market realities. The paper silver market in New York shows relatively modest premiums and normal trading patterns, as if nothing unusual is happening. Futures contracts for March 2026 delivery are trading in the mid-70s range, while dealers trying to source actual physical silver for immediate delivery are paying premiums of 70% to 90% above COMEX spot prices. This divergence reveals a truth that precious metals analysts have warned about for years, but that mainstream financial media has consistently dismissed. The paper silver market traded through COMEX futures and options represents claims on silver that far exceed the physical metal actually available for delivery. As long as most market participants are content to settle contracts in cash rather than demanding physical delivery, this system functions smoothly. However, when demand for physical metal surges while supply contracts, the illusion of unlimited paper silver at stable prices collides violently with the reality of finite physical metal. Arbitrage traders who normally profit from price discrepancies between different markets are finding their traditional strategies completely unworkable. In theory, a trader should be able to buy COMEX silver at $73, take delivery, and immediately sell that physical metal in Dubai at $127, pocketing a risk-free profit of $54 per ounce minus transaction costs. In practice, securing delivery of physical silver from COMEX warehouses has become increasingly difficult, and the timeline from purchase to actual possession of metal has extended to weeks or months rather than days. The breakdown of arbitrage mechanisms that should equalize prices across global markets signals something more profound than temporary logistical disruptions. When price discovery fails and different venues quote radically different values for the same commodity, market participants lose the ability to make informed decisions based on reliable pricing information. This creates uncertainty that ripples through industrial supply chains, investment portfolios, and monetary policy calculations that rely on precious metals as inflation hedges or safe haven assets. Understanding how global silver markets reached this breaking point requires examining the structural vulnerabilities that have accumulated over decades of financialization and paper-based trading. The COMEX silver market operates primarily as a derivatives exchange, where participants trade contracts representing claims on future silver delivery, but where actual physical delivery remains relatively rare. Data from recent years shows that less than 2% of COMEX silver futures contracts result in physical delivery, with the vast majority settled in cash at expiration. This system worked efficiently when physical silver supply remained abundant and when most market participants had no intention of taking delivery. Investment banks, hedge funds, and algorithmic traders could execute massive positions in paper silver without ever concerning themselves with the logistics of storing, insuring, or transporting actual metal. The paper market provided liquidity, price discovery, and hedging opportunities for industrial consumers and mining companies who needed to manage their exposure to silver price volatility. However, the relationship between paper prices and physical availability depended on an assumption that physical supply would always be sufficient to meet delivery demands if they suddenly increased. Chinese export restrictions have shattered this assumption. When the world's largest silver producer stops exporting metal, the supply available to satisfy Western delivery demands contracts dramatically, while the number of outstanding paper claims on silver remains unchanged. The Shanghai Futures Exchange position limit reduction amplifies the supply shock by signaling that Chinese regulators expect their domestic silver market to experience extreme volatility. Position limits exist to prevent individual traders or institutions from accumulating positions large enough to manipulate prices or create systemic risk. When exchanges reduce these limits by 50%, they're effectively telling the market that normal position sizes have become dangerous given current market conditions. Chinese industrial demand for silver continues accelerating despite export restrictions, driven primarily by the solar panel manufacturing sector. China accounts for over 80% of global solar panel production, and each panel requires significant amounts of silver for photovoltaic cells. As China pursues ambitious renewable energy targets, domestic silver consumption for solar applications alone could absorb most of the nation's mine production, leaving little or no surplus for export even if restrictions were lifted. The Trump administration's trade policies targeting critical minerals have further complicated the supply situation. Tariffs and strategic stockpiling initiatives aimed at securing domestic supply chains have created additional demand for physical silver while simultaneously disrupting established trading relationships. When governments begin treating commodities as strategic assets rather than freely traded goods, market dynamics shift from economic optimization toward national security considerations that override price signals. Physical silver dealers in Dubai have become the global bellwether for true supply-demand dynamics precisely because Dubai operates outside the Western financial system as paper-based pricing mechanisms. Dealers in Dubai's gold and silver souks deal exclusively in physical metal with immediate delivery. There are no futures contracts, no cash settlements, and no leverage. When someone wants to buy silver in Dubai, they pay cash and take possession of actual metal within hours. The prices quoted in Dubai therefore reflect pure supply and demand for physical metal without the distortions created by leveraged paper trading. When Dubai dealers quote silver at $127 per ounce, while COMEX shows $73, the 54 premium represents the market, as assessment of how scarce physical metal has become relative to the abundance of paper claims trading in New York. BMO capital markets analyst Colin Hamilton warned in mid-January 2026 that silver's recent price surge appeared overdone, and predicted a pullback to the $65.70 range. Hamilton's analysis focused on COMEX paper prices and traditional supply-demand metrics that assume normal market functioning. However, his forecast failed to account for the complete breakdown of arbitrage mechanisms and the bifurcation between paper and physical markets that Chinese export restrictions have created. Meanwhile, technical analysts like Michael Oliver are projecting silver prices could reach triple digits within months based on momentum indicators and long-term breakout patterns. Oliver's analysis examines multi-decade price charts and focuses on major structural shifts in market dynamics rather than short-term fluctuations. His triple-digit price targets align more closely with physical market realities in Dubai than with COMEX paper prices. The divergence between institutional analysts focusing on paper markets and physical market realities illustrates how Western financial systems have become disconnected from underlying commodity fundamentals. The implications of this silver market bifurcation extend far beyond the precious metals sector, threatening to expose vulnerabilities in broader financial markets that rely on paper-based price discovery mechanisms. When the largest commodity exchange in the world quotes prices that diverge by 70% from physical market realities, confidence in paper markets as reliable pricing mechanisms begins to erode. This erosion carries consequences for industrial planning, investment allocation, and monetary policy that depend on stable and transparent commodity markets. Industrial consumers of silver face particularly acute challenges navigating this pricing chaos. Electronics manufacturers, solar panel producers, and medical device companies that require physical silver for production cannot simply settle their needs with cash payments like financial traders. These companies must secure actual metal to maintain their supply chains, and they're discovering that sourcing physical silver at prices anywhere near COMEX quotes has become virtually impossible. Companies that hedge their silver exposure using COMEX futures are finding their hedges provide little protection against the actual costs of securing physical metal. A solar panel manufacturer who sold COMEX futures at $75 per ounce to lock in costs might discover they need to pay $120 per ounce for physical delivery, leaving them with a $45 per ounce loss, despite having supposedly hedged their exposure. This breakdown in hedging effectiveness forces industrial consumers to question whether paper markets serve any useful risk management function when disconnected from physical realities. Investment portfolios holding silver through exchange-traded funds and other paper-based instruments face similar uncertainties. Most silver ETFs claim to hold physical metal backing their shares, but the fine print in prospectuses often reveals that these funds may use futures, contracts options, or other derivatives to achieve silver exposure rather than holding 100% physical metal. When physical premiums surge to 70% above spot prices, investors holding paper silver claims may discover their investments provide minimal exposure to actual physical market dynamics. The 180-day timeline referenced by some analysts represents a critical countdown to potential resolution or escalation of this crisis. Chinese export restrictions implemented in late 2024 came without specified expiration dates, but some industry observers believe Beijing may reassess these policies after 6 months, based on how domestic markets and international relationships evolve. If restrictions remain in place beyond this 180-day window, Western markets will need to accept that Chinese silver supply may be permanently unavailable, requiring fundamental restructuring of global supply chains. Alternative supply sources cannot easily replace Chinese production. Peru, Mexico, and Poland represent the next largest silver-producing nations after China, but their combined output barely matches Chinese production, and most of this supply already serves established markets and industrial consumers. There are no massive untapped silver mines waiting to come online in response to higher prices. New mine development requires years of exploration, permitting, and construction, meaning supply cannot respond quickly to demand shocks. Secondary supply from recycling provides some cushion, but recycled silver flows also face constraints. Electronics recycling, jewelry melting, and photographic waste recovery all require time, processing capacity, and economic incentives to scale up. Even if recycling rates double, the additional supply would take months or years to materialize and would still fall short of replacing Chinese exports. Central banks and governments are beginning to recognize silver's strategic importance beyond its role as an industrial commodity or investment asset. Silver's critical role in defense electronics, solar energy infrastructure, and advanced manufacturing makes it a strategic material comparable to rare earth elements or semiconductors. When strategic materials become scarce, governments intervene with stockpiling programs, export controls, and supply chain subsidies that further distort normal market functioning. The Federal Reserve's monetary policy decisions complicate the silver market outlook further. If the Fed maintains higher interest rates to combat inflation, the opportunity cost of holding non-yielding assets like silver increases, potentially dampening investment demand. However, if persistent inflation erodes confidence in fiat currencies, silver's monetary properties as a store of value could drive investment demand higher, regardless of interest rate levels. The interplay between monetary policy and commodity markets creates additional uncertainty in an already chaotic pricing environment. Market participants are discovering that traditional analytical frameworks fail when underlying assumptions about supply, availability, and price discovery mechanisms no longer hold true. The path forward for silver markets depends critically on decisions made in Beijing, Washington, and trading floors worldwide, with each actor responding to incentives that may drive markets toward either resolution or further chaos. Chinese authorities must balance domestic industrial needs against international trade relationships and the economic benefits of silver exports. The Trump administration faces pressure to secure strategic materials for domestic manufacturing while avoiding trade policies that escalate into broader economic conflicts. COMEX and other exchanges must decide whether to modify contract specifications or delivery mechanisms to restore market integrity as physical supply constraints intensify. Several potential resolution scenarios could emerge over coming months. Chinese authorities might ease export restrictions if domestic silver supply exceeds industrial demand, or if diplomatic pressure from trading partners intensifies. This would allow physical metal to flow back into international markets, gradually closing the premium gap between Dubai physical prices and COMEX paper quotes. However, this optimistic scenario requires China to prioritize trade relationships over domestic industrial policy, which seems unlikely given current geopolitical tensions and China's focus on renewable energy self-sufficiency. Alternatively, COMEX might modify contract specifications to acknowledge physical supply constraints and adjust delivery mechanisms accordingly. The exchange could increase delivery premiums, extend delivery timelines, or create separate contract categories for guaranteed physical delivery versus cash settlement. Such changes would acknowledge the bifurcation between paper and physical markets, while providing clearer pricing signals to market participants. However, major contract modifications risk fragmenting liquidity and creating uncertainty that drives traders to alternative venues. A third scenario involves Western mining companies and governments coordinating to rapidly expand silver production capacity outside China. Strategic investment in mines across Mexico, Peru, Poland, and North America could eventually replace lost Chinese supply, but this process requires years and substantial capital investment. Government subsidies, streamlined permitting, and infrastructure development would need to accelerate to meaningfully impact supply within relevant timeframes. The most concerning scenario involves continued divergence between paper and physical markets, leading to a complete loss of confidence in COMEX pricing and a shift toward purely physical settlement in decentralized markets like Dubai. If industrial consumers and investors conclude that paper markets provide no reliable connection to physical metal, they might abandon exchanges entirely in favor of direct dealer relationships and bilateral contracts. This fragmentation would destroy the liquidity and price transparency that made COMEX valuable while increasing transaction costs across the silver supply chain. For investors and industrial consumers, this market dislocation creates both risks and opportunities that demand careful navigation. Holders of physical silver in allocated storage accounts may see the value of their positions appreciate substantially if physical premiums persist or widen further. However, investors holding paper silver through futures, ETFs, or mining stocks may find their exposure provides minimal correlation to physical market dynamics. Understanding which category one's silver exposure falls into has become essential for accurate portfolio assessment. Industrial consumers facing immediate silver requirements must decide whether to pay elevated physical premiums now or risk even higher prices if supply constraints worsen. This decision involves assessing how long Chinese restrictions might persist, whether alternative supply sources can scale quickly enough to ease shortages, and whether one's competitors have already locked in supply at lower prices. Companies that delay purchasing decisions to avoid high current prices might find themselves unable to source material at any price if physical scarcity intensifies. Mining companies face strategic choices about how to market their production. Selling silver through traditional channels at COMEX-linked prices means accepting significant discounts to physical market values. However, shifting toward direct physical sales requires developing new distribution relationships and possibly violating existing delivery commitments. Miners who navigate this transition successfully could capture substantial premiums, while those locked into disadvantageous contracts might miss the opportunity entirely. The silver market crisis of early 2026 will likely be remembered as a watershed moment when decades of paper-based financialization collided with physical reality. Whether markets adapt smoothly or experience prolonged disruption depends on decisions being made right now by regulators, traders, and policymakers worldwide. For those paying attention, the message is clear. The relationship between paper claims and physical commodities cannot be taken for granted, and understanding this distinction has become essential for navigating modern commodity markets.